But if I have to really think about what could stop this particular bull market, it's going to be something about the belief of institutions buying Bitcoin. So what's the narrative right now? You never sell because the institutions like BlackRock and Fidelity, they're they have to buy all this Bitcoin because there's all this pent up demand from institutions who want to incorporate Bitcoin into their portfolios. And there's all these diamond hands out there who aren't going to sell their Bitcoin. So there's a very low supply of Bitcoin left to sell, which means the price goes asymptotic on the upside.
In this recent interview, Tom Billies speaks with Arthur Hayes about his bold prediction that Bitcoin could reach $1 million amid an impending financial crisis. They discuss the impact of energy constraints and resource protection on global inflation and the importance of actively using Bitcoin to preserve its value. At the time of this discussion, Bitcoin was trading around $59,000, with a 3% increase in the past 24 hours and a 10% rise over the last week. Before we continue with the rest of the video, do check out Daily 5-Minute Crypto Newsletter with all the latest crypto and Bitcoin news. It's a fantastic analysis of on-chain crypto data and breakdowns, and the best part is it's absolutely free. They'll cover expert predictions, breakdowns of on-chain crypto data, and any breaking news you need to know, all in a nutshell. Click the first link in the description and enter your email to join over 50,000 others in becoming a better crypto investor right now.
I think this cycle is a cycle where we break the sovereign debt markets, where every single major country finally admits that we will do anything it takes to make sure that the government does not go bankrupt. And so we're going to remove all this pretense about caring about sound money, and we're just going to start printing money like it's going out of style. And so I think this cycle is going to be a bit different than the last cycle, where the Fed and then every other central bank said, oh, we've overdone it. Let's try to reduce it. They tried, but the governments are still printing money because they need to get reelected. And we're in an inflationary environment. You know, there's too many old people. Everyone's going to go to war at some point. So everyone's beefing up on defense. And so the central banks have come back in and said, okay, we got to print money, but we can't really call it quantitative easing or the things that we called it before. So we'll make up new names for it. But it's the same thing. And so we want to protect the government bond market and make sure the government can continue to borrow at below the economic growth that they're creating. And so I think right now we're in this cycle where people are realizing this, and you have the professional investor class are also realizing it because they've had the worst bond performance, at least in the United States, since the War of 1812. Over the last 3 years, U.S. Treasuries, 30-year Treasury is down 50% on a real basis. That is the worst return since 1812. Now, you wouldn't know that by listening to the financial press, but bond investors are getting absolutely eviscerated. And as they come to the realization that this is not good, maybe we should own something else, that's sort of this secular rise and sort of Bitcoin. So I don't think it's going to be a similar type of credit event that's going to cause prick the bubble and crypto and everything else that happened in 2021. But there's going to be some change in that mindset, and that's what I'm looking for. And there's no real one thing you can point to. It's kind of just be cognizant of the fact of, why do you think the market's going up? Is there something that's happening that's challenging that worldview? Well, I think that we're going to get some sort of credit event in the government bond markets. And then we're going to see
you thought they were just going to print?
Yeah, they're going to print. And I think some people are going to try to exert an influence of saying, hey, these bond markets, they still matter. We're not going to buy a treasury at 4% when nominal growth is at 6% or whatever it is, right? And there will be an event, and there will be a way, an off ramp to say, okay, we want to reform the system or change something, and we'll see what the authorities decide to do. I think they're just going to keep printing more money, and we keep going higher. If we think back to the stats I just said, so the bond market as of we want to think about really when this bull market started to gain a lot of steam was October of last year. So essentially what happened, and I'm going to focus on the U.S. Treasury market because that's the most important one globally, and every other market sort of depends on that from a government bond perspective. You have this thing where interest rates on the debt was rising, but at the long end, it was rising faster. So post the September Fed meeting, the the spread between the 10-year bond and the 2-year bond was increasing, meaning the 10-year yield was rising faster than the 2-year yield. And in general, both are right. The yields are both rising at the same time, which is basically called a bear steepener in fixed income trading terms. And that is deadly for banks and the entire financial system, because the entire financial system is modeled post sort of 1970s, 80s on this assumption that when back end interest rates rise too quickly, that the authorities will come in and print money to save the system. Now, they did do it, so the market got it right. But in the meantime, all these financial institutions, in the way that their complex financial derivatives are structured, ignore this particular quadrant of the potential outcomes and thus have massive losses. And this is what we were seeing across the banking system. So if you looked at the, regional bank stock index or KBW index, which is all US banks, they're getting crushed going into late October of last year. And so what happened? The US Treasury and Janet Yellen, she said, okay, I'm going to stave this market. I'm going to issue a bunch of short-term debt and take money out of the reverse repo program at the Fed, which is just this $2 trillion facility of cash just sitting there that's outside of the financial system. And she offered a higher rate on short-term Treasury bills to entice this money out, and which reflates the system, gives more credit money into the system. And that sort of helped, fuel this bull run that started essentially on November 1st of 2023. So we're going to get another event like that, because if the Fed, the Treasury, and their other global central banks and fiscal governments, if they continue to do what they're doing, but say that on the one hand, we want to try to fight inflation by not printing money, we're going to get another situation like we got in the third quarter of last year, where the bond market says, hold on a second, what do you want to do? Do you want to safeguard the value of fiat currency, or do you want to make sure that the government is funded? And I don't know when that situation is going to happen. There's lots of tricks that they can pull, probably a little bit too mundane for this particular venue, if you really want to get into US money markets. But there's going to be another situation like that. And you could see a general, risk off, meaning financial assets decline on that situation, on the fear that maybe this time they're not going to save the banks and print the money and reflate the system. I don't think that's going to happen. I think they'll do the same thing they've done every single other time. But you could get a situation like that.
As we just heard, Arthur Hayes discussed the potential for Bitcoin to reach $1 million amid an impending financial crisis. He highlighted the unsustainable nature of government bonds and excessive money printing. Let's explore further, as he explains how the flattening of energy production and countries safeguarding their resources are driving global inflation. Arthur sheds light on how these factors are causing soaring energy prices and affecting the global economy. He also emphasizes the importance of actively using Bitcoin, rather than just holding it, to maintain its long-term value. Now, let's hear more from Arthur Hayes.
Now, obviously, that can be true for a while, but it won't be true forever. And so at the point in time where we start to see a massive leveling off of the allocations of money into these products, then that narrative starts to shift, and people can become less confident that there will be, a few $100 million of buying of Bitcoin every day from all these major ETF fund managers. And I think that might be the thing that I'll be looking for, which says, okay, whatever the price of Bitcoin is at that point, maybe it's time that I think about, at least for the other non-Bitcoin and Ethereum assets, getting out of all of those, right? And I have a very big venture capital portfolio of early stage crypto tokens that will need to be liquidated. And then on a more philosophical level, I have to think about, well, if Bitcoin has risen to such a high level relative to the energy that it represents, maybe I should own a power plant or a massive stake in ExxonMobil or something where I actually own the fundamental energy source and I got it at a very cheap price relative to the price of Bitcoin. And that's a way that I can take some chips off the table in Bitcoin terms. But what I probably won't be doing is selling Bitcoin or Ethereum for fiat, because I still think that the fiat system is fucked and I don't want to participate in that. But primary energy, if I can own those resources at a very attractive price, because Bitcoin and Ethereum and these other assets have been bid up to such an insane level, then that's probably something I should be doing. The put option on government bond market. And so I think we're at the point where the largest government bond market admits that we can't afford this, so we're just going to print the money anyways. And that's the option that you're really trading on Bitcoin. You want to be around for that, because that's going to be, and if it happens this cycle, it's going to be absolutely insane. And so that's when I'm running an essay right now, and the tenet of the essay is people don't have enough imagination about how ridiculous this bull market can get. So if we combine the Bitcoin is now available from a financial perspective to be ingested into TradFi portfolios, and you have TradFi portfolios do not want to own bonds because everybody knows that this is what's going to happen in the treasury market and JGB market, ECB's bonds, China bonds, all the different bond markets. If these confluence of factors, this is the situation where the 40% of managed money that's in fixed income or basically sovereign bonds globally, a portion of that goes into crypto. And so you have a massive amount of fiat that can only go through a very, very small door. You just get insane price appreciation across the whole space. I don't think people appreciate that right now. They're like, oh, is Bitcoin at 70,000? Maybe I should take some off the table. No, you fucking shouldn't. This is a time, if this is the narrative that you were operating under when Bitcoin was 16,000, we haven't even gotten to that point yet. We've just started. This is just like the amuse-bouche. It's not even the fucking entree yet. So we're just getting started in this thesis of the collapse in terms of, we have this one asset that's real. We have this whole Fugazi financial system. For the first time in history, we have an ability to express a put option on these bonds in an easy digital fashion versus, going out and holding a vault of gold, which is quite difficult. So that is the insane bull market thesis that I've been operating under. We're marching towards that. I don't want to be underallocated if I'm right. If I'm wrong, we get, maybe Bitcoin goes to 100,000, 200,000, whatever it is. And okay, cool. Made a good chunk of money. We'll prepare for the next cycle because it's coming. If it's not in the 2025, 2027 timeframe, it'll be when there's the global world war of the, end of the decade or a little bit after, as we've come to this situation where every government's printing money because they're going to war with each other. So that's the trade.
In this insightful discussion, Arthur Hayes explores the potential for Bitcoin to reach unprecedented heights amid financial turmoil. He delves into the significant impact of energy constraints and resource protection on the global economy, and underscores the importance of actively using Bitcoin to maintain its value. We'd love to hear your thoughts on a few questions. What do you think of his predictions? Do you believe that active participation in the Bitcoin network is crucial for its long-term success? How do you see energy and resource protection affecting global markets? Share your thoughts in the comments below. For more Daily Dose crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.